Hello, everybody. We will start our webinar soon. I'd like to introduce Paulo and Reza. And today we will talk about how to invest and save in Canada. So let's start in some few seconds. But first, we'd like to talk about how is the weather today? It's so nice. In Vancouver and in Toronto, yes?
Yes, it's probably on the mid-20s here in Vancouver. Sunshine.
Very nice.
Yes, and Reza and me, we are in Toronto, is the same. Almost amazing.
Yeah, we have, what is the temperature right now? It's 29.
29.
Wow. Summertime.
It's either too hot or too cold here. That's the issue.
Yes.
So do you want to slowly start then? I think we've got some of our viewers who are joining.
Yes, let's start.
Yes.
So today we'll talk about investments in Canada, and part one is how to invest and save in Canada. And we have a very nice presentation with Paulo. Say again, Paulo, because it's very difficult.
Moulatlet. Don't worry about my last name. Just say Paulo.
Yes, yes. Okay, help me. And we can start because we have a lot of good information to discuss and to show for our clients. So I'd like to introduce and we can start. I think Reza can start our presentation as Mingiwi, and after this presentation, we have the presentation of Paulo. Thank you.
Yes. Thank you, Daniela. Thank you, everybody, for joining us at Ingwe Immigration's Canadian Investment Webinar, part one of a series of webinars we're offering newcomers to Canada, potential newcomers in the future, and applicants from overseas who are considering Canada as a future residency or even investment. So today's webinar is how to invest and save in Canada. Our guest speaker, Paulo Moulatlet, I hope I pronounced that correctly. And I'm going to do a quick introduction about Ingwe, who we are, about our webinar series about investment, and then we'll pass it on to the main speaker. Let me see if this works. Hold on. I'm not the best. Okay. So who's Ingwe Immigration? I'll be very quick because most of you know us already if you're already in this webinar. We have 2 offices worldwide. We serve over 25 different countries and nationalities. We have over 15 team members, both in Canada and overseas. Our team speaks over 7 languages. You can check our Google ratings. That's where our customers voice their satisfaction with us. And basically what we are is we are a global mobility company and boutique investment. So we help non-residents, we help newcomers, we help people to invest in Canada, whether it's their children's education, whether it's to invest, or whether it's to immigrate. Who am I talking? Reza Moulatlet. I'm a licensed immigration consultant here in Toronto. A little bit about myself, just so you know, so I'm not giving you bad advice. I've gone through everything myself personally. I immigrated and lived in Canada, and basically I immigrated here actually twice to Canada, and I went through 4 countries, 6 cities. I've lived in Vancouver, Montreal, and Toronto, plus a whole bunch of places overseas. I've managed and operated different businesses overseas, import, export, logistics, property investment, and a whole bunch of other stuff before I came to Canada. I'm currently managing several family companies inside of Canada, including Ingwe. And I manage my family's portfolio of property investments and developments to create wealth for me, family members, and our friends and clients. I'm licensed in 2 provinces to buy, sell properties inside of Canada, and I have purchased, managed properties and assets in 6 different countries in 3 different provinces in Canada. So I've dipped my hands in almost everything. So to put it in a short way. So what does Ingwe Immigration do? How do we help people? Well, we help them with business immigration that will lead to permanent residency. We help people, applicants, to come and study here, or for professional type of skilled immigration that will eventually lead to permanent residency. And we help with overseas investors who want to balance their portfolio, right, and invest directly in Canada because they want to mitigate political risk, currency risk, or any other types of risks without the need for immigration, because immigration is not mandatory for investment in Canada. What are the top 4 destination countries that we help our applicants with? It's Canada, Spain, Portugal, and Malta. These countries are always changing depending on the politics and how easy it is to immigrate. And here we are with our main presenter today, Paulo, who will show you the big picture and the details of planning your financial growth and independence in Canada, how to save money, how to save for your future investment. And your investments could be your children's education. It could be life insurance. It could be assets like property investment. It could be equities and bonds. So, and eventually leading to a very comfortable retirement in Canada. So it's very important, everybody who's considering moving to Canada or is already here, to understand how the financial world works and what to do to plan and have a stable financial life in Canada. So without further ado, we're going to pass it on to Paulo. Our second part of this webinar series will be about ABCs of real estate. So in June, we're doing the second part of this webinar where we explain in very plain, simple terms, the truth and all the things you need to know to buy or sell real estate in Canada, okay? And I know a lot of people who come here, they have to learn just through experience or bad experiences. And this whole webinar series with Ingwe offering investment guidelines and facts and information is to prepare everybody on their financial path to, either they're in Canada or they're planning to come to Canada. And one of the things that we'll be covering in the next webinar in this series is how does everybody afford housing in Vancouver and Toronto? You know, you're coming from these countries which have devaluation of currency, and there's all these other immigrants, but everybody's buying and selling. How do they do it? What's the secret here, or what's the logic? What it is possible for all nationalities, no matter where you're from. And the point is leveraging your investments, which is borrowing basically, and locking in real estate prices. Real estate is not the only type of investment. Paulo is going to discuss obviously a whole bunch of other financial instruments, but in the second part of this series, we will be covering that as well. You have all of our contact info, and now we will pass it on to Paulo. Paulo?
Well, thank you so much, Reza and Daniela and all the team at Ingwe. Quite an introduction for Reza. I'm going to skip my introduction because it's not going to be even close to what he said. So how many countries? 4 countries. How many languages, Reza?
No, I don't speak a lot of languages, but yeah, I've moved around quite a lot, but you know.
But anyway, so good afternoon, everyone. And once again, thank you for the opportunity in being here. As Reza said, I'm going to talk as the big picture about financial planning. And financial planning can be a very broad, comprehensive topic. So I'm going to just, in a nutshell, just give you an idea of what the financial planning is. And let me just share my screen here, 1 second. Just 1 second. Where is the share button here?
It's at the bottom, I think.
Let's see, 1 second. It's like there is some difficult technologies here. Let me just find my share. Okay, 1 second. I just have to close all my. Okay, I don't see my share on Zoom. I can see I'm here, I'm live, but I don't see my sharing button. Why?
Do you see any of the buttons on the bottom of your page, Paulo, like participants, Q&A, chat,
No,
mute,
no,
stop
one
video?
second. Okay, there we are. There we are. I got it. I got it.
Good.
Okay. Share. Okay, there we are. Sorry, guys. Can everybody see my screen? Okay. So financial planning, I gave the title for newcomers. Most of you guys are newcomers. Most of you are already established here. So I have to get a title. I went with the newcomers. So the agenda for today, the presentation should take between 20 to 25 minutes. I also will have a case study. It's a simple one that should take between 15 to 20 minutes. And then I guess Daniela will host the Q&As. We are aiming for 20 minutes, but if it goes over the 20 minutes, as long as you guys are okay, I'm okay with time. I do have to share this disclaimer. If there is any lawyers in the audience, please get out of my presentation. You're not going to like the disclaimer here. And a little bit about myself. As I said, not quite impressive as Reza, but I do have a good experience in the financial services sector. Originally from Brazil, I immigrated here in Canada in 1995. My background, I am a civil engineer, but here in Canada, you know, when you come to Canada, you're pretty much nothing at the start. And that's exactly what happened to myself. So I have to find a job, and I started as a bank teller. And then throughout those years, I moved from position to position, from financial institution to financial institution. And then in 2005, I became a certified financial planner. So I took my CFP designation, and I already had my investment license. And I decided that rather than be dealing with somebody else's problems as becoming a branch manager of a bank, I decided to help people. And that's what I have been doing pretty much since 2005. I am an airplane pilot. And actually, by matter of fact, when I came to Canada, the whole idea was to become an airline transportation pilot. And the dream never came true, but I still have my license. I still fly here in British Columbia, in the Lower Mainland, in Vancouver. I am married with 3 teenagers, and I live in Surrey, British Columbia. So this picture here was taken in one of the local mountains, the Mount Simmer. Currently, I am an independent financial planner, and I use Manulife Securities as my dealer. As some of you know the name Manulife, Manulife is the largest insurance company in Canada, and they have several divisions. One of the divisions is the Manulife Securities, which is pretty much a broker that I use to connect my clients with the investment companies and insurance companies. So let's start. So I saw that quote from Benjamin Franklin that says, if you fail to plan, you are planning to fail. So, I mean, what is the plan? So as I said, financial planning is more than investments and mortgage decisions, right? It's the big picture. It's the comprehensive process. It's the process of creating personalized strategies. And those personalized strategies, it's unique to your situation. Like each one of my clients has a different situation where I analyze and I personalize a strategy to help them meet their goals and objectives. And of course, how do I do that? Using the management of their financial affairs, of what they have. So the financial planning will consider all relevant aspects of your life and will include all of those which are the most important. So budgeting, investing, tax considerations, retirement planning, estate planning, debt and risk management. So we are going to cover all of those topics today. And we are going to say, what are the steps of the financial plan? So step number 1, it's identify your goals and objectives. And by the way, they have to be achievable goals and objectives according to your situation. So then we have to gather your financial situation, your financial affairs, like where are you? What do you have? What resources do you have? What is your income? What is your expenses, etc. So then we are going to analyze your goals and objectives together with your financial affairs, and we are going to develop a plan unique to your situation. And then eventually we are going to present and implement this plan. And most important is monitor and review this plan. I always make an analogy with the steps of financial planning with a checklist on an airplane. Like every single pilot, for more that the pilot knows his or her airplane, he goes over the checklist to make sure that nothing was missed. So the steps of a financial plan is a checklist. It's a checklist for you to make sure that you are on track. And for more that the financial plan can be done sometime in the future, like 20 years from now, 30 years from now, after you die, after you depart from this world, things will change like throughout the years. And what are going to be those changes? So some of you are going to get married, will have children, will go back to school, will buy a house, will sell a house, will retire. Unfortunately, will develop some health issues, will divorce, will change jobs, will open a business. There will be so many changes that will impact your plan. So let's start with budgeting. Budgeting is the most important piece of the financial plan because budgeting is the one that will give you the cash flow, right? And the cash flow is the difference between your income and expenses. Very simple. There is money coming, there is money leaving. Hopefully, the cash flow is going to be positive. It can be situations that is negative. So then a financial planner will try to mitigate some of the expenses or increase the income to make this cash flow positive. So as I said, budgeting is very important. So what is income? Anything, employment income, pension income. We are going to talk about this type of account called registered retirement income funds. It's a type of a private pension. We are going to talk about the Canada Pension Plan. It's a government-funded pension. Old age security, it's also another government-funded pension. We are going to talk about investment income. Some of you are going to have some money and they want to generate an income out of these investments. Some people will have a disability income, like they will, eventually, unfortunately, some people will become disabled and there will be some sort of income as a disability income. As Reza stated at the beginning of this presentation, his specialty is the real estate market as well. Some of you will have rental income, etc. So expenses, we classify the expenses as the essentials and the non-essentials. So I always say the non-negotiables and the negotiables. So the non-negotiables are those ones like mortgage payments, your rent, property tax, house insurance, condominium fees, hydro, gas, cable, telephone, maintenance, etc. Those are the expenses related to your house, which non-negotiable. You have to pay those expenses and that's it. So there is no discount, there is absolutely nothing. And then there will be also what we call the fixed expenses. Some of you, depending on which province you are, will have to pay for your provincial insurance. You may have some personal insurance like life insurance. Some of you will buy a vehicle and need to pay for the loan payment. Car insurance, gas, cellular bill, medical, pharmacy, groceries, etc. So those are the expenses that they are considered essentials. And then there is the variable expenses. Those are the ones that really we have to watch for. The dining out, the travel, the entertainment, the clothing, the gifts, etc. Those are the expenses that we don't need them, but we sure like them. And those are the ones that can really place our budget in a very difficult situation. So to summarize, budget is very simple. Income, expenses, cash flow. Cash flow ideally has to be a positive cash flow. So steps for a healthy budget. So first of all, the most important one is pay yourself, right? Pay yourself first. So usually 10% of your earnings should be paid to you. Like we pay everybody else, but what about ourselves? So very important, pay yourself first. Take track of all your monthly expenses. There is budget applications there for your phone, smartphones, as you can use a regular spreadsheet. Classify the expenses as the essential expenses and the non-essential expenses. Buy only the necessary. For you guys that are coming to Canada right now, credit is going to be quite difficult to get at the beginning. But once you are established, they will give you credit on your wallet. So be careful. Shop for the best price. Be wise when using credit. I already said that on item 4. Okay, 1 second. I went back here. You guys are seeing my presentation still? Sorry.
You have to share it again.
I have to share again? Okay, sorry. Something happened. That's my apologies.
Yeah, we can see it now.
You can see it? You guys can see it? Okay, sorry guys. So be wise when using credit. Consolidate all your debts with a lower interest rate. So again, unfortunately, we will accumulate debts in line of credits, different credit cards, so it will be easier to have all the debts with the lower interest rate. Very important, 6 months of emergency funds. So that would be 6 months of your salary, right, of emergency funds. Include on your budget the expenses that you only pay once a year. Like there is certain bills that you only pay once a year, like property tax is one of them. So you can make monthly payments to the city, but what I do usually, I have a separate account that I throw them money on a monthly basis so that it becomes part of my budget. Compare your monthly expenses with previous months and previous years to make sure you are on track. And keep a good credit. This is very important. Very often people ask me about credit score. So the credit score, especially for the newcomers when you are coming to Canada, do not use more than half of your available credit and pay that on time. So good credit will be essential, especially when you are going to apply for a mortgage to buy a house. So let's talk now about retirement planning. So your well-being tomorrow requires planning today. And I always tell my clients, start as early as possible. Do not delay, right? So what are the steps to retirement planning? Determining your goals. It's when do you want to retire, right? And how much money do you require for your retirement? Later on the presentation, I'm going to show what is the Statistics Canada retirement income for a couple. Taking your current financial situation and projecting to the future, right? So whatever you have right now, how are you going to take advantage and maximize your savings and use your assets that they can become part of your retirement? There will be cases that individuals will accumulate equity on their house, and eventually when they retire, they can either sell the house and enjoy the income coming from the house, or they can borrow against the house as a home equity line of credit and enjoy an income out of the house, out of this borrowing to use on their retirement. So there is strategies that can look after that as well. analyze the income gap. Like, you know, you will need an income at retirement, and then what is required and what is available, and how do we close that gap? And of course, identifying the strategies that will best suit your goals. So that would be the steps to retirement planning. What are the risks at retirement? Well, first of all, life expectancy. We are all going to live longer. And they say that we are going to outlive our retirement, right? You already see people that they are, you know, going to 100, right? Inflation can be a problem. Right now, inflation in Canada is relatively low, but, you know, if situation changes, it can erode part of your capital. Healthcare, right? This is other important thing to watch. As we live longer, there is a typo here on my presentation, my apologies, it's aging population. As we live longer, you know, the costs of our maintenance to maintain our good health will become more expensive. So we may need to buy private healthcare, so those costs might increase. Very important one, withdrawal rate. Too many withdrawals on your money that we are trying to save for retirement right now could seriously compromise the longevity of your capital. And one important one is the asset allocation. Not having a well-diversified portfolio can potentially compromise the growth rate of your capital. And what is a well-diversified portfolio? It can be part of your portfolio, can be a house, can be equities, can be bonds, can be mutual funds, can be a variety of different asset classes, right? So that's really important. So in a nutshell, retirement steps for success. Budget. So we need to establish a budget that will let us know where the money is going and identify which expenses can be eliminated. Time is very important. The sooner you begin to save regularly, the less you will have to put in to achieve your retirement goals. How many times I have clients in their late 50s coming to me and say, oh, I need to save for retirement. I say, well, we only have 10 years. Well, I didn't save. So it is a problem. Save regularly, as I said. Get a habit of setting aside a portion of your paycheck towards an investment of any sort. So save regularly, it's really important. As I said, the cost in Canada, it's increasing year after year. So it is estimated that a couple in their 65 years of age and older will need, according to Statistics Canada, at minimum $64,300 a year after tax. So after tax means in order for you to obtain $64,300, you have to have a higher income, because this is the actual net income that they will need to retire. So, and again, this is across Canada, but you know, cities like Toronto and Vancouver can be quite expensive. So let's talk a little bit about what are the retirement pensions that they are available in Canada. So we have the government pensions, the private and the public pensions, and then the retirement income from private plans. Like, do not confuse the retirement income from private plans with private pensions. So private, it's from the private sector, corporations in Canada, that they are not public, that you know they are private corporations, or even corporations that they are public, and the public, the government offices, right? So they are called the public pensions. So let's talk about the government pensions. So government pensions in Canada, there are two. There is the Canada Pension Plan, and there is the Old Age Security. So the Canada Pension Plan, the minimum age to retire from that plan is 60 years of age with a 36% reduction. And I will explain to you guys what that means. What does that mean? The normal age is 65 years, and the maximum age is 70 years. 70 years, you get an increase. So for someone that has been in Canada and had worked approximately 39 years before turning 65, and has contributed the maximum that this individual can towards the Canada Pension Plan, today, if this individual is to retire at age 65, this individual would receive $1,203.75 a month. Those are figures from March 2021. If the same individual is to retire at age 60 from the Canada Pension Plan, it will be reduced that amount by 36%. If this individual is to wait until age 70, that amount will increase by 42%. And again, this Canada Pension Plan, it's one of the pensions. And you don't, I mean, this is where it becomes a little bit confusing. You don't have to retire altogether at 60 and get the Canada pension and the other pensions. You can retire from the Canada pension at age 60 and continue to work, right? It's not that you totally retired. The right word here would be you can start receiving the Canada pension at age 60. A question that people ask me is, well, I just came to Canada 5 years ago, and I'm not going to be working here for the 39 years before turn 65. Am I going to get the Canada pension? Yes, everybody that makes a contribution to the Canada pension, no matter how long you have worked before age 65, you are going to get the Canada pension, but you are not going to get the maximum amount, right? And there is calculations that I can help you guys guess estimating how much you are going to receive. I will talk more about the Canada pension on the next slide, but I just want to touch base about the old age security. Old age security, it is another government-funded benefit. The maximum payment as of March 2021, it's $615.37 a month. There is no minimum, the minimum age is 65. You cannot take your old age security at age 60. And you will be available for all residents that have met the residence requirements. And the residence requirements are, if you are a resident of Canada, minimum of 10 years before age 65, this is one of the requirements. Or if you are not a resident of Canada, but you were a resident of Canada and you were here for 20 years, you can also receive the old age security. The maximum amount that you get, the $615, would be if you were a resident for 40 years in Canada. As an example, if you are only here for 10 years, you will get 25% of that amount. And down below, if you were not here and you were a resident of Canada for 20 years, you are going to receive half of that amount. So as you guys can see, if we add those two amounts, it's still far away from that $64,000 that we need to retire. So this is just a piece of your retirement. So Canada Pension Plan, besides giving you a pension, which is the retirement income, it also offers a disability income for individuals that become totally disabled and can no longer do any other type of work. Also has some sort of death benefits for you and your family members. So if you were to pass away, there will be a death benefit that will continue to be paid to your survival or to your children. So minimum age to retire is 60 years of age with a reduction of 0.6% a month for every month prior to the age of 65, which is 36% if you take at age 60, or an increase of 0.7% a month if you decide to postpone your retirement. Everybody that works in Canada between the age 18 and older, working for Canadian companies, have to contribute to the Canada Pension Plan. And the way that works is 5.45% of your salary between to what's called the yearly maximum pensionable earnings, which this year happens to be $61,600, will make a contribution of $3,166.45, and your employer will also make an equal contribution as well. If you happen to be self-employed, guess what? You have to pay for yourself and you have to pay for your corporation. So then you have to pay $6,332.19. This YMPE, this yearly maximum pensionable earnings, it goes up every year. And the goal is to go all the way to $80,000. So right now it's $61,600. When I came to Canada in 1995 was $34,900. Everybody that makes more than $3,500 a year to this YMPE will have to contribute towards the Canada Pension Plan. So this is just a spreadsheet about the Canada Pension Plan showing what is the maximum amount if you were to work 39 years before age 65 and contribute the maximum of that YMPE, which changes every year. The average amount that they are paying as of October 2020 is $689. So as you can see, the majority of the residents are not receiving the $1,203.75. If you decide to work longer than 65 and not take your Canada Pension Plan, so they will increase your benefit by $30.09 if you were to get the maximum amount. And then the average, it's $8.80. So that $30.09 will be added on the top of the $1,203.75. If you were to become disabled and you get the disability pension, those are the amounts. If you happen to die before turning 65, your survivor will get those amounts. If you die after 65, your survivor will get those amounts. If you are disabled, your children will get, the children of disabled will get those amounts. If you are to pass away, your children will receive those amounts. It pays a one-time death benefit of approximately $2,500. And then he has what they say the combined benefits. If you have a spouse and you pass away and your spouse is retired as well, between what is the survival and what the spouse would get from his or her retirement will not exceed those amounts. The same for the disability. So it is, as I said, it is a quite complex topic, but we can expand that if needed. Old age security, that's the one that you just have to be a resident. You do not have to make any contribution to this plan, and you will receive, if you are a resident, the maximum of $615. However, the old age security will not pay anything to you if your income is big or higher. So for the ones that they are 65 years of age and make an annual income higher than $125,075, are not going to receive anything from the old age security. Most clients, most seniors here in Canada, they may have an income that high, depending on how their accumulation of wealth has been. So that's where I come in play to find the strategies, to find investments that they can be sheltered from taxes so that they can enjoy that old age security. This clawback, it starts to claw back when their income is higher than $79,845. So before that, they get the full amount. After that, they start the decrease until become zero at an income of $129,000. There is also some additional benefits on the old age security for low income earners. which is called the guaranteed income supplement, which can be an additional $919. So this is the old age security, not paid by you directly, but indirectly by the taxpayers. Retirement planning. So next one will be the pensions, like the pension plans from public sector and private companies. So the best pension plans available in Canada are what they call the defined benefit pension plan. And the name defined means the pension is defined, the benefit, you know how much you are going to receive when you retire. Usually those plans are offered through good corporations and also the public sector, like the firefighters, the police, the nurses, the teachers, the city workers, government workers. They will receive this benefit pension plan, and it's based on a formula of how many years you have worked, and they will take in consideration your best 5 years of work. So the benefit is defined. It is the best pension plan available in Canada. The one that it's becoming very popular with the corporations, it's called the defined contribution pension plan. This one here, the contribution is defined, and it's up to you to make a wise investment decision based on the choices that the pension will offer you to make sure your money will grow and you are going to have an income upon your retirement. So the onus is on you, not on the corporation. There is a new one that was introduced a few years ago, which is the pooled registered pension plan, which is very similar to the number 2. I'm not going to expand too much on that, but it's there for you guys to know. So on a side of the government pensions and the public and the private pension plans, there is now the private plans, which is the ones that the majority of you guys one day are going to get. And the most popular one, it's called the RRSP, the Registered Retirement Savings Plan. The group RRSP, it's similar to the Registered Retirement Savings Plan, but it's done by a company. And then the locked-in retirement account is a pension plan that you had while you were working for a company, one of those defined benefits or defined contributions, and you have left that company since, and you took the commuted value of that amount and you set it up a private plan for yourself. And some corporations will give an incentive to their employees through what it's called the profit sharing plans. So today we are going to talk a little bit about the Registered Retirement Savings Plan. So what is the Registered Retirement Savings Plan? It's a private savings account. It's called registered because it has a fiscal benefit or a fiscal incentive by the government. Contributions towards that account will decrease your taxable income. So you make a contribution to the RRSP, you pay less taxes. That's how it works. The money then will be invested inside of the RRSPs, and this money will grow tax-free inside the RRSPs. And you can invest in different types of investments, like there will be different choices for you. The contribution limit to make a contribution towards that RRSP, it's a formula. It's 18% of your earned income of the previous calendar year, not exceeding the maximum limit of $27,830, which is the year 2021. And people say, what's that? Well, if you make $200,000 a year and you multiply $200,000 by 18%, it's $36,000. So, however, the maximum you can contribute for that year will be $27,830. You can use previous years RRSP.
Question, Paulo, sorry to this. how long can you carry it forward? Is it indefinite, like 10 years, 5, if you never used the RSP contribution?
You can carry forward until age 71. At age 71, you have to turn the RSP into a RIF. Yes, but you can carry forward all the way to age 71. This is the last year that you can make a contribution on your RSP.
Okay, so if you never contribute and it just adds up,
yes,
it just carries. Okay,
correct. But what happens is, in a given year, if your income is really high, there will be a cap, right?
Yeah.
And the cap is there because CRA also wants to make money, right? If you keep contributing as all that your income towards an RSP, they will lose revenue at your income tax.
Yeah. And this is where everybody who's watching has to pay attention, because it's a tax deferral instrument, which Paulo is explaining. Okay, thank you.
And there is a strategies to play with this tax deferral. But as I said, we won't have time today. It can be, we can spend an hour talking about RRSPs. Just giving you an idea of what they are. RRSP, it's one of the accounts that you can actually name a beneficiary on that account. They are individual accounts. They belong to you, but if you want to name a beneficiary upon your death, like if you were to pass away, you can name a beneficiary and the money will go direct to the beneficiary. And this will bypass the will, it will bypass the probate. Even if you have on your will so-and-so as beneficiaries of your assets, the RRSP, it's one of the accounts that they will not look at the will. They will go straight for whoever you named as a beneficiary or beneficiaries. And depending on the type of beneficiary or beneficiaries, it can have additional tax implications. I'm not going to expand on that because, as I said, it's an hour talking about RRSPs. Now, RRSP, I always tell my clients, it's what it's known by robbing Peter to pay Paul. And Reza already said that you are deferring your taxes. Why robbing Peter to pay Paul? When you make a contribution, you get a tax benefit. When you take the money out, you pay taxes. Throughout the life of the RRSP, regardless of how the RRSP was invested, the investment will not pay any type of taxes. It doesn't matter. You bought shares of a corporation that they cost 10 cents and they became $10. You do not pay taxes. But when the money leaves the RRSPs, you will be paid taxes. And how those taxes are paid, whatever money you are taking from your RRSPs will be added to your taxable income for that year. The name of the game is make RRSP contributions in years that you are on a high tax bracket, so you get a higher tax deduction from your RRSPs, and withdraw the money when you are on the low tax bracket. When the situation happens, usually, well, when you are working, you make the contribution. When you are retired, suppose you're not making as much money, that's when you take money out of the RRSPs. So one way or the other, you will be paying taxes later on. So this is just an example here for a contribution. So if your income is $60,000, approximately $11,000 is left as income tax. Your after-tax money is $48,000. If your income is now 60 and the taxes that you had to pay is $11,000 and you make an RRSP contribution, they will then subtract that $6,000 from your taxable income, will recalculate your taxes, and your taxes that you were supposed to pay was $9,500. Therefore, you get a tax refund. And one thing that I'm not sure if I have that on any slides, I may have later on. The income tax system in Canada is in what called brackets or tiers. So more money you make, more taxes you pay, right? So this example here, this income tax bracket, it's approximately 28%. But once you make more than $100,000, you go in what's called the 40% income tax bracket. So the people that really make the high earners, they really need a tax break, and they always look for opportunities with RRSP contributions. So what RRSPs can be used for? Several things. The most popular ones is the home buyer's plan. And Reza will explain to you guys later on, but basically you can use up to $35,000 of your RRSP towards a down payment on your first time house in Canada. Now, when you take this $35,000 and use as a down payment, there is no tax implications. However, the CRA, the revenue agency, wants you to give this money back to your RRSPs, and it will give you 15 years for you to return this money back to your home buyer, to your RRSPs. And basically, so if you take $35,000, so then you have to return this money in 15 installments of approximately $2,333 a year. If you fail to return this money to your RRSPs, CRA says not a problem. They will get that $2,000 that you were supposed to return and you didn't, and they will add that to your taxable income and you pay taxes, right? The other use for RRSPs, oh, and by the way, this $35,000 is per individual. With a couple, there is $35,000 for one and $35,000 for another one. Now we are talking about $70,000. The other use of RRSPs, it's called the lifelong learning plan, where you can use $20,000 if you decide to go back to university. So you can use $20,000. Then you have 10 years to pay that money back, which is $2,000 a year. RRSPs can also be part of your emergency funds, but just remember, any money you take out of the RRSPs, you have to add to your income on that year and pay taxes. Hopefully, if it's emergency funds, means you are not working and you are using that money, and it's not going to place you in a tax situation. And RRSP, of course, it was designed to be part of the retirement plan. Once you retire, those public and private pensions, the ones that we talked earlier on, the defined benefit and defined contribution, you can turn those private pensions into an income. And the earliest you can do that, it may be at age 55, depending on the pension plan. The normal age is 65. The RRSPs and the group RRSPs, there is really not any specific age that you can turn those things into a retirement. Like you can, whatever you want to open the tab and take money out of the RRSPs and pay taxes, but you will be forced to, when you turn 71, convert your RRSPs into an RRIF, Registered Retirement Income Fund, and take a minimum payment. And that minimum payment then will be taxed. So up to age 71, you can do whatever you want. After 71, you have to convert into a RIF and take a minimum payment. And the locked-in plans, which I spoke earlier on, they were the pension plans from corporations or public sectors that you have worked, and you transfer into a locked-in RRSP. The reason is locked in because you cannot really take the money out as you wish. There will be restrictions there, but depending on the legislation, you can take that at age 50, but again, no later than age 71. I think I had enough about RRSPs. Rez, I'm not sure how are we doing with time? Like I'm just, because I'm talking here, talking, I'm not sure what's happening. Can anyone give me an idea what's?
We're at 7:25 now. So because we started at 6:30, we can, and how many slides are left to explain everything?
I was just going to talk about a little bit about insurance, and there was a case study, but I mean, I'm not sure if we'll get there. I mean, it is, unfortunately.
I think it's, for people who are here, they're not browsing, they're actually looking for information. So I don't know if, Daniela, if you agree, we can continue a little bit about insurance, but I think the case study will be quite important for everybody to kind of conceptualize and apply the
Yes.
knowledge that you've given us here, Paulo, right?
Okay, so
Yes,
I'm just going to
perfect.
fly by the insurance. So
Okay, sure.
the other aspects that you guys should consider is insurance. Like if I die, why do I need money? You don't, but your family, your loved ones, your business, they will need insurance. So there are several types of insurance in Canada. I mean, as I said, I'm not going to expand that much, but the most popular one is the life insurance, the disability, critical illness, travel, extended health benefits. Why do you need insurance? To protect an asset, which is associated with a debt. So usually if you buy a house and you take a mortgage, what happens if you die? Well, you have insurance that will pay for the mortgage, and then you have a house that it's paid for. It protects your income, protects the family, protects your children. If you don't have any of the above one, and you may have a charitable organization that you want to leave a legacy, insurance will be a good way of doing it. And also will help with intergeneration transfer without paying taxes. Life insurance in Canada is a tax-free instrument. Investment planning, and again, we only spoke about the registered accounts, which is the RRSPs, but there is also the tax-free savings. There is also the education savings plan, the disability savings plan. There is several types of registered accounts. And just to make it easy, registered account is an account that the government has set it up with a tax benefit or a tax payment, right? And the non-registered account is just a regular investment accounts that they are non-registered. So those are the two types of accounts. I mean, I forgot about that, but the tax-free savings will be another popular account that very common, like very similar to the RRSPs. It doesn't give you a benefit when you make a contribution. You don't pay taxes throughout the life of the tax-free savings. And then when you take the money out, you don't pay tax. So it's exactly opposite of the RRSPs. The RRSPs, you need to earn an income to make a contribution there. The tax-free savings, as long as you are a resident of Canada, you know, it doesn't matter if you're a permanent resident or just a temporary resident. If you have a social insurance number, every year you can have a $6,000 accumulation room to deposit into the tax-free savings. To the right, the education savings plan, it's available for a family that have children under the age of 17, where contributions towards that account to a maximum of $2,500 a year per child, the government will add 20%. And then there will be the maximum that the government will add for the lifetime of that account. There is also another benefit called the Canada Learning Bond, which can be up to $2,000. And there is also the Provincial Education Savings Grant. Children between ages 6 and 9, if your province qualifies for, they can get an additional $1,200. So it's an account that is used mainly for education for kids. Maximum amounts to make on those accounts are $50,000. Can I beat the tax man? Probably not. This is but you can do tax strategies, right? Those are the Canadian income tax brackets in Canada. And this is federal and Ontario combined tax brackets for 2020. So if you make $44,000 in Ontario, you pay 20% of income and then so on. And, you know, unfortunately, more you make, if you make over $220,000, now you're paying 53.53% of tax. Like the government becomes your partner on this business. How do you mitigate taxes? You cannot avoid taxes, but you can choose tax efficient investments, tax sheltered investments, tax deferred investments, income splits with family members, etc. A little bit of succession planning. Everybody in Canada, I strongly recommend that you do a will, you do a power of attorney, and have everything laid down because you don't want your loved ones to go through a hassle. I think I will stop here, like for the presentation. Should we turn to the case study?
Yeah, so do you have slides for that, Paulo?
Yes, yes.
Okay, great, yeah.
I just have
and
to
just
find...
one question before you jump in. So one point is you could also borrow against your investments. Is that correct?
Correct.
Yeah.
Correct.
So for those people out there who are thinking, okay, all this money is going to go into this RRSP or this insurance product or this or that, these are potentially assets, correct? Right. That could be leveraged up to a certain percentage that the bank or the lender would be comfortable with, right? So, so it's not money that's locked in for 70 till you're 7 years old, for example, right?
Yeah, and usually the leverage strategies is done as you would borrow money to buy a rental property, right? So yeah. The whole idea is you're going to invest into something that pays some sort of income. Yeah. So then you can, of course, claim that income on your income tax and then write it off the interest rate of the borrowing of the loan on your income tax, similar to what a rental income property would be.
Yeah, exactly. So, and if anybody of our viewers right now is overwhelmed with information and completely confused, this is why Paulo is Paulo, right? So
I am overwhelmed with the information myself.
Yeah, it's so in Canada, well, other countries too, you don't need to know everything because it's literally impossible, right? There's a tax act. Like, you know, there's people who have to handle the taxes. There's people like Paulo who handle your financial planning. So you will not know everything unless, like Paulo, you went, you were educated, you have experience, you've been trained. So the point of this webinar is to understand the general concept of all these possibilities and potential paths, and then connect with a very capable and reputed financial planner and securities advisor like Paulo. So that's the point. It's not to memorize everything and try to apply it yourself. It's actually to understand, hey, there's so many options out there. I need somebody to help me out. And Paulo, just a little bit of a thing. You don't get paid directly from the client, right? If I come to you, you don't charge me and be like, hey, Reza, I'm going to charge you $100 an hour to tell you where to invest, right?
Good point. So the way that my agreement is with my dealer, which is Manulife Securities, if you were to become a client of mine and you were to own the financial planning, utilize some of the products that the dealer is offering, the dealer will receive compensation by ways of commissions from the different investments and insurance companies. And myself, Paulo, will get a portion of that. So we call that the value of advice. So I will get paid. And I do get paid. But yes, I do not charge to do a financial plan.
Yes. So unlike immigration, where we charge you upfront to do something, Paulo doesn't, right? So it's only after the fact where he gets paid if you do an investment, which is great, which means that, hey, if you planning and, you know, in Canada to have some financial stability, long-term growth and security, Paulo is your person to go to, right? So now we can jump into the case study, Paulo. Sorry about that little interruption. Are we there? I think there was a disconnect. Daniela, can you hear me? I think everybody can.
Yes.
Okay, so I think Paulo's internet. And there you have it, everybody. Toronto internet is faster than Vancouver internet. No, I'm just kidding. I'm just kidding. So while we're waiting for Paulo to reconnect, I think he got this. He's going to reconnect. He's going to do a case study. Are there any questions so far that, you know, we can maybe ask him to kind of in his case study to explain? So if there's any questions anybody has, maybe they can post them. And when Paulo's back, we can ask him while he's explaining the case study, he can kind of elaborate and sort of answer the questions indirectly. Daniela, what do you think so far?
Yes, the clients are always asking what is the most difficult part in living in Canada. And it's not immigration, it's not studies, it's not work, it's buy a house, it's save money, it's pay for the house.
Yeah,
so after you become a PR,
taxes. Yeah.
And taxes, yes.
Financial
we have
planning,
a lot of taxes in Brazil.
Yeah, Brazil
as well.
is a lot of that. Like if you want to import cargo into Brazil or all these, there's so many duties, there's so many taxes. Canada, we have taxes, but it's still a good balance. It's not impossible. Yes. And that's the thing, everybody. Paulo is there to help, right? So take advantage of connecting with a very capable and competent financial advisor, securities. He's a financial planner and a securities advisor, investment advisor. So you have to be, because there's a lot out there. So if you go to a bank, they will immediately introduce somebody. But I'll be honest, I've gone to banks and not all of them are capable. Like sometimes they just tell you to buy these things or invest in these things and they don't even know what they're talking about. So it's important to connect with the right people, right, Daniela?
Yes, because sometimes your goals is different from the other families and you need someone that understands what you need and plan for your family, for your goals.
Yeah. So I think, okay, here we go. Paula's back. Paula's back. Hi, Paulo, how are you? I think your battery, your laptop, computer or something happened, right? Something happened to your battery.
No, it's my internet that disappeared.
Okay. No
worries. Reza said Toronto internet is better than Vancouver.
I don't know exactly what happened. I cannot connect here with my, let's see here. Like I need at least to show you the case study, but I can't see it now. One sec. Not see it. How do I send to you? How do I send to Danielle or to?
Do you want to email it to me, reza@ingwe.ca?
Okay, I'm just trying to log here. 1 second.
Or Danielle, even doesn't matter. Yeah, we lost a few of our viewers while you were gone.
So, yeah, my like I'm using my phone. Let's see if I can connect my computer with my phone. I think I can.
Yeah, let me try to log. Just hotspot it.
Hotspot, exactly. That's what I'm trying to do here. 1 second.
That's good. That's good.
I think I'm coming back up live. Yeah, my internet is totally gone. 1 second, guys.
Sure.
Okay, I'm coming back. I'm coming back on the...
Okay. Yeah, perfect. So you have to cut your audio. Okay, there you go.
Okay. Can you guys hear me?
Yeah, don't worry. Go ahead, Paulo. You're on track. Just share your screen. We're good to go.
Now, okay, I'm going to share here my presentation. 1 second. Sorry, guys. It does happen, unfortunately. I'm just 1 second. Okay, it's coming. Presentation, retirement. Come on. Okay, Can you guys see my screen?
Yes.
Okay, so this is a case that I did like a couple, so male and female, 40 and 41 years of age with 2 kids, 9 and 7. And the assumption is they are going to retire at age 65, and the life expectancy for this couple will be age 90. I also make an assumption that the inflation will be around 2%. I mean, there is questions here that I ask if they have a will. Like I always ask that question. No, they don't have a will in this case. And then the salary for this couple, it's about $75,000 a year for one and $55,000 for the other one. And the salary, I also made an index by 2%. So every year that income will increase by 2%. And we can, we can adjust the numbers as each unique situation. As I said, this is just an easy, simple financial piece. I believe the husband, Mr. John Doe, he also will have a defined benefit pension plan of $20,000 a year. And I calculated that this benefit will be indexed by 1.3%. So all those numbers that I'm showing here, they are today's numbers. Of course, in 25 years from now, when they retire, those numbers will be adjusted by 1.3%. Their salary will be adjusted by 2%. On the case of this couple, they are new immigrants to Canada. When I show the Canada pension benefit and the old age security, I said the maximum they can get in today's dollar amount, it's about $1,200 for the CPP, and which is the Canada pension plan, and $615 for the old age securities. I'm making an estimate that they are not going to get that. They will get approximately 60% of the Canada pension for him, 50% for her, and both have been in Canada. They will be in Canada for 25 years. They will get 60% of the old age security. This is the 2 kids. There is John Jr., and then Miss Ann, it's the daughter. Each kid will have university costing approximately $10,000 a year for 4 years. And this is just a basic number. Depending on the type of degree, it may cost way more than that. And this is how much money they should receive on a monthly basis, this couple, when they retire. Like the dates here means for one of the kids, they will go to university 4 years, the other one 4 years. And then this couple, which when they retire in 2045 until they are age 90, they should receive $5,000 a month net so they can live. All of this is adjusted by inflation. And I said, this $5,000 is its today's dollar amount, will be more in 25 years from now. They own a house which was purchased with money that they brought from their country when they immigrated to Canada, but they have a mortgage of $435,000. It doesn't show here where the mortgage is, but I know there is a mortgage. And then we made some assumptions that the growth of their investments will be approximately 8% a year, which is not far away from reality. And what they have, oh, here is the mortgage, 435. They are paying a high interest rate. Should be lower than that today, right, Reza? It's 3.75. Anyway, one of the things is, between the couple, they make $98,000 after tax money. And remember when I said pay yourself first? So what I did, I created 2 registered retirement savings accounts for the couple. And I also created the registered education savings account, 2, one for each child. And I took that $9,800 divided by 12, that's $98,000 is a year. So he gave me approximately $400 on a monthly basis of savings, which is pay yourself first. So sorry, not $400, $800, my apologies, $800. So I divided this $800 between the two registered education savings accounts. And then I also divided between the two RRSPs. But what I did with the RRSPs, I added $200 between the years 2021 and 2044. And then when the kids no longer need the money for their education, I added that portion that we were saving for the kids into their own RESPs from those dates all the way to their retirement. So, and I did not adjust that dollar amount. I just kept as $800 a month, and I kept all the way for their retirement. So what happened was, based on that and based on the $5,000 that they need, when they retire, I'm just going to the next slide. When they retire, they are not going to achieve their retirement goal. They will be at 94%. So the software then gives me an option to say, what are my choices? How do I achieve 100%? And 100% would be $5,000 every month in today's dollar amount. So how do I achieve 94%? So the system is telling, you know, in order to achieve 100%, you need to save an additional $52. And this is what I work with the clients. Like, I mean, how do we make those goals to happen? Do we adjust the income at the end, or we add more money now? And each case will be a unique situation, right? So this is just to give an example of how the software works. So by increasing $52 a month, they can then retire. And the same with the kids. One of the kids, which is John Jr., which he is older, he's not going to get 100% of this $10,000 for 4 years. So what we have to do, we have to pay him an additional $42 every month so that they can have his money for education. And for the other child, because the other child was younger 2 years, she will have enough time to accumulate all the money needed. So as I said, Reza and Daniela, this is just a simple financial plan. I mean, it was not complicated at all, but the software is really good. So we can, you know, I can play with the software any way I wish. So I think I spoke too much. My apologies for the glitches here.
No worries, no worries. So we can field some, we can quickly jump to, so I'm just gonna take over the screen if you don't mind, Paulo.
Yes, just go ahead. Thank you.
We're going to go into the question answer. So here, Daniela, we can field questions. Hold on, let me see. There's one from current slide. Okay, let me share. I'm a bit slow. There we go. Okay, so our contact info here, and let's see your question answer. So here we have Paulo's email address, Daniela's email address, and you know, this is the opportunity for viewers to actually ask questions. I know it's overwhelming, right? But no question is, you know, I don't think there's any question that we cannot answer with Paulo here. And don't worry if you think the question is too obvious or too simple, and you're worried that, you know, maybe, you know, you're supposed to know certain things. You can field any questions. So Daniela, what do you think?
I think the best questions that can be answered by both is when I can buy a house, and how much I need to have to start a down payment plan, or how is the beginning, how I can combine Reza knowledge and Paulo knowledge to buy a house.
So yeah, I mean, I think Paulo, what basically a lot of our viewers like Daniela mentioned is that at what point can you help them to realize at one point they can afford a mortgage, basically?
Right. So, well, basically, I mean, all depends of what type of house you are going to buy, the value of the house. Like the rule of thumb is whatever is the value of the property, there will be a minimum down payment of at least 5% of the house if you are going to go in what's called a high ratio type of mortgage. The general down payment is about 20%. So here is the thing. Like, first of all, you have to do a calculation based on that. Well, if I buy a house worth $500,000 as an example, and I'm going to do a 20% down payment, it means $100,000 down payment. I need a mortgage of $400,000. So I would start this exercise backwards. Okay, how much money do I have to make on a yearly basis that I can afford a $400,000 mortgage, right? If I'm going to give a down payment of 20%. What if I don't have 20%, I only have 5%? So 5%, it's only $25,000. There will be some additional insurance. So let's see, the mortgage amount will be $490,000. I mean, how much can I afford in terms of monthly payments to have a mortgage of $490,000. So the exercise, I would start with asking the client, what is the income more than how much money you have for the down payment? So at least we know how much mortgage you can afford. And unfortunately, Reza knows that better than I, the government of Canada has added what they call a stress test, which is an interest rate that the government puts in place, saying this is the worst case scenario. At least you should be able to qualify with that interest rate, not necessarily mean that that's going to be the interest rate you're going to get. But that's where I would start. Like, I would start backwards. Let's see how much mortgage you can afford, and then I can help you with the down payment. Well, how do I help with the down payment? Well, you have to start saving somehow if you don't have a down payment.
Exactly.
And for the most of the people, I encourage to take advantage of the RRSPs, because worst comes to worst, the RRSP will give them a tax benefit upon making their deposits, right? I'm not sure, Daniela, if I did answer the question, but that's how I would approach.
No,
like,
it's perfect.
I go backwards, right?
Yes, we have a lot of clients that want to understand, oh, I need to become a PR to buy a house, or no, what happens if I'm not a PR, or how I can understand all the scenarios.
No, it makes sense, Paulo, what you mentioned, because what you're saying, so what a lot of our viewers have to understand is that the investment and savings is directly connected to any kind of, let's say, real estate or other purchase of assets that they plan, right? Because as you mentioned, you can use your RSPs as a couple as first-time home buyers. So don't think of them separately that, oh, I have to invest in something for my retirement, and then I have to buy a, let's say an asset like a property, and they're exclusive. No, they are connected, right, Paulo?
Yes, correct. I mean, it's all part of the plan. Like, it may be the short term, the medium term. It's to accumulate enough money as a down payment, and then after that, you have to pay back this money that you used for down payment, and you start accumulating again for your retirement. I mean, it's, as I said, when I said at the beginning of the presentation, it's just a guideline. It's just a checklist, right? Each case will be a case. Each situation will be a situation. And we have to monitor that on a yearly basis. Not that you get the plan and throw on your drawer and that's it. You have to monitor that on a yearly basis.
That's why they need to be working with somebody like yourself, who's always available, and you re-look at it. And what I don't like, I love this topic, by the way, Paulo. I love it even more than immigration, is how to make money, how to save money, and how to create wealth, right? How to grow your financial footprint. And for most newcomers, do you think when you arrive at the airport, the CBSA officer tells you about RSPs, or the fact that how to invest, who gets paid, who has commissions, what the risks are, what the tax implications are. Nobody tells you that, right? Right?
And with my experience, Rez and Daniela, like when I'm working with a client that it's new to Canada, it doesn't matter how sophisticated this client was in his or her own country.
Yes.
Here in Canada, it is different. Like, I mean,
Yes.
they didn't know, they didn't have an account that you don't pay tax. Like you're telling me there is a tax-free savings account. Yes, there is a tax-free savings account. I mean,
Yeah.
they have no idea or how things work. So usually when I work with a client like that, sometimes it takes me 3 meetings before the client can make a decision of what to do. Like my job, it's more as an educator, like just to, you know, show what are the benefits, the advantages, the disadvantages, how they work, what are the tax implications. So sometimes it does take a little bit of time, but I enjoy. I do enjoy. Like, I mean, it's very rewarding for myself when people understand. You know what? Yes, Paulo is correct. Like, you know.
No, 100%, Paulo. And this is the main thing to take away from this webinar, everybody, is that like immigration, financial planning is also, you know, there's complications. There's a lot of information out there that most people will not have a full sense of, and not every advisor is created equally. And what I mean by that is similar like immigration, financial planning and investment advisors like Paulo, they're not all the same quality, right? So when you go to the bank, immediately they will connect you with somebody to sell you some fund, you know, RSPs or hedge funds or whatever. But they're not all the same. Same like immigration. Some of them, like Paulo, really know their stuff, right? But some of them have no clue. And somebody who's been living here for a while and I've immigrated twice to Canada, I can attest to that. That, Paulo, they're not created equally, right? Some people like yourself, they really know their product. They really know the information and can give proper advice. But some of them, they're not giving, they're not like, you know what I mean, Paulo, right?
Yeah, absolutely. Absolutely. No, each case is a case, each plan is a plan. I mean, I have like several clients, maybe 250, 300 household families.
Yes.
Each family has a different story. I do not have anybody that it's equal. Like everybody is different. That's what makes this job unique. Like, you know, you hear those lifestyles, like real life cases, and say, wow. But you know, that's exactly why I'm here. It's really guide you people. It's make people comfortable with their decisions. At the end of the day, it doesn't matter how I feel. It matters how they feel. And I always tell my clients, a good financial plan is the one that you are able to go to bed and you sleep and don't wake up worried during the night, right?
Yes, yes.
I mean,
reduce the stress, reduce unknown risk. And that is one of the main things that everybody should understand when they're doing financial planning, is that there's risk all around us, but identifying the risk and balancing the risk reward is what's important. People are taking unnecessary and unknown risks, which is when it becomes dangerous, when you're planning with your family's savings, your children's future, the education, your main home, you know, all these things, right, Paulo?
Yeah, and I always tell people that there are things in your life that you can control. So control it. Take advantage of that. There are things in your life you cannot control, and nobody knows when they will come. Like all the years that I have been working as a financial plan, I have made all different scenarios, all different worst case scenarios. One day, a meteor is going to hit Earth. A tsunami is going to wipe out Vancouver. An earthquake is going to do whatever. He never thought throughout those years that a pandemic was going to stop the world. Never thought. Nobody ever thought about this.
Yes.
Right? And yes, it's here. It's here, and we have to adapt, and we have to live with this thing. I mean, what else can we do?
Yeah, exactly. And I believe that because of all the overwhelming information, it's, you know, people are overwhelmed. So there's no specific questions, but I think you've done a great job in terms of outlining the big picture of all the different subjects or pieces of information they should be considering and reaching out to somebody like yourself who can help them with their financial plans here in Canada. Because if, as you said, if they were back home and they were managing their own finances and they were gurus, Canada is a very different landscape, right?
Yeah, I agree. I agree. And they have to start like, oh, I mean, I don't have enough, or I don't have to. I mean, you have to start somehow, somewhere. Like you have to get used to the system. Yeah. And you know what? Life is ever changing. The dynamics are really going to change that quick. Oh, exactly. Daniela disappeared.
Daniela, yeah, the internet caught up with her. But yeah, so everybody, thank you for joining us. So the good thing, Paulo, is that this session is recorded. It will be posted on our YouTube channel and our other social media channel, so people can refer back to this video to understand and learn and really comprehend of all the different financial instruments and solutions possible for them here in Canada. And your contact info is there for them to reach out to you directly. And again, why Ingwe is providing these services is to educate potential newcomers, existing newcomers, and even people who've been here for more than 5 years, but they don't have a clue why they would need to invest in an RRSP.
Correct. And just so Reza, before we go, like now, my license for either investments or insurance, they are valid for the provinces of British Columbia and Ontario.
That's great.
I don't have license for other provinces because there was no need, no clients that will go to other provinces. But nothing would stop me to open those licenses to other provinces if clients are to become clients on those provinces. Because I understand Ingwe has clients all across all the provinces, correct?
Yeah, no, that's great to hear. So as you heard, there's over 200 families that Paulo is financially advising, right? Planning with them. So if they can trust them, that means you can trust them. Everybody who's watching today, whether it's pre-recorded and you're watching this on our YouTube channel or our social media or not. And that's what it is. We've handpicked the best of the best, Paulo Moulatlet, right? And this is, again, something that they have to start thinking about. And it's part of our webinar series. And we will be back in June with another second part of this investment webinar. I would like to thank Paulo for coming and doing the presentation today and really explaining the financial landscape here in Canada for newcomers and how to save, how to plan, and the potential pitfalls, right? Taxation, growth, investment. Thank you, Paulo.
Thank you, Reza. Thank you, Daniela. Thank you, Ingwe. It was an honor. Thank you.
Yes, no, I appreciate it. We will be in touch. We look forward to doing more events with you. And again, everybody, Manulife is it is the largest insurance company in Canada. It is a Canadian company, so homegrown, which is very important because you cannot trust every insurance company. And they have their banking license. They do mortgages. They do insurance. They do securities and investment. So they have the full package. And we, Ingwe, have our medical benefits with Manulife. So that just proves to you, if they're the best, then we trust them as well.
Excellent. Well, thank you.
Thanks, Paulo. I appreciate it. We'll see you soon. Thank you, Daniela. Thanks, everybody, for joining us today.
Thank you.
Thank you. Bye-bye.
Take care, everybody.
Thank you.